Welcome to TFE Talks, Navigating Wealth, Business, and Legacy, the podcast from Thomas Fisher and Edwards. Each episode, our attorneys bring you expert insight on estate planning, business strategy, and legacy building, breaking down complex topics into clear, actionable advice. Whether you're solidifying a strategy we've discussed or preparing for what's next, this podcast is your resource for thoughtful, practical planning. You ready? Let's dive in.
Hello and welcome to another edition of TFE Talks. I'm your host, Jordan Goewey, and I'm joined once again by Matt Edwards, who, as I've introduced before, is a shareholder here at Thomas Fisher and Edwards in Greenville, South Carolina. Matt, we've got another great topic to talk about today. We're going to focus on income tax basis, and that is a very important topic when it comes to any sort of tax planning or any sort of ownership of assets or the sale of assets. And it's something that a lot of people get confused on from time to time. And so hopefully this podcast can help clear up some of that confusion for them. And so first of all, thanks for joining today. And are we ready to get started here?
Absolutely. Thanks for having me. It was a pleasure.
All right. So at the start, Matt, let's just talk about what is income tax basis and why is it important?
So income tax basis is really one of the important measures of how we determine how much taxable gain someone has, generally when they sell or transfer an asset. So basis is usually the price that someone pays to acquire an asset, whether it's a house, car, a stock, a piece of real estate, anything like that. So whatever they originally acquire that asset for.
In general, I think you're right. You go buy an asset and your basis in that asset is going to be what you paid for it. What if you were to not pay anything for it? What if someone just gave you an asset? What basis do you have in the asset at that point in time?
Right. And so our basis can come to us in a number of ways. And so the default rule for basis is really just whatever you've paid for it. But maybe, like you said, someone just gave you an asset. You didn't buy it yourself. You didn't pay for it yourself. If, for example, Jordan, you gave me something. I see some baseball bobbleheads on the windowsill behind you. Let's say you had a very valuable baseball bobblehead that you bought a few years ago, and then you gave it to me. You bought it for $100. If you gave it to me, I would take that same basis that you had in it as I acquired it. So then I would have a baseball bobblehead with a basis of $100. It may be worth much more, and I may sell it for much more, but what its basis to measure taxable gain is what you originally acquired and then transferred to me at.
Yeah, and so that obviously is going to become very important when you later sell an asset. And so how about, just to kind of give one more layer to it, what if there's like a startup or something where it's a new business, it wasn't given to you, you're starting it, but you also didn't pay anything for it? How do you establish basis in something that's an entirely new asset? Like if I go and I just start a business, how do I determine what my basis is in that business?
Right. Usually that is going to be a combination of both the dollars that you put into that basis or into that asset, into that new business, and any assets that you put into that business, and as well as expenses that you may expend to start that business up. So, for example, if Jordan, you and I wanted to start a business together, maybe to go buy a piece of rental real estate, we start an LLC together and you put in $50,000 and I'd put in $50,000. My basis in that business is going to initially, based on those few facts, going to be $50,000.
So we've covered a lot of the ways in which basis is established. You buy an asset, it's what you paid for the asset. You start a new business, it's what you put into the business to begin with. Mm-hmm. An asset's gifted to you, you're taking the basis that the prior person had in that asset. But you and I are estate planners. So I would say that one of the biggest places that we start thinking about basis is when someone dies. And why is that a crucial part of the basis planning process when a person passes away?
Right. So it's important to consider why we have basis, and that is It is a measure of one of the measures of how much taxable gain we have if we were to dispose of the asset or we give it away and someone else disposes of it. And so, again, Jordan, you and I start this business and we put in $50,000. If we sold that business to somebody else, we would receive an amount of funds and we'd measure it against our basis in that business. And this portion is taxable. Not our basis is taxable, but the portion, the difference between the basis and what we received would be that. And that's the same rule with gifting. We take that basis when somebody gives it away, and then if we sell, we have to pay that. Assets transferred at death, most assets, will receive a new basis in the hands of the heirs, whoever receives those assets after someone passes away. So if my grandfather owned a piece of real estate in Greenville County and he had a very low basis because he acquired it a long time ago, and he left it to me in his will, at the time of his death, we determine the value of that property, and the basis is then reset as to be what the value is at the date of his death. So he may have had a very low basis during his lifetime, but me inheriting that asset would receive a stepped up basis to fair market value. And so people will refer to this as a step up in basis. It can be a step down, and so we don't see that very often with a lot of appreciating assets, particularly as much appreciation as we've seen in Greenville and South Carolina and the Southeast regionally. But it is a new basis at death, and that occurs for most assets that someone inherits.
And so, Matt, in a lot of ways, that kind of seems like a pretty large giveaway for the new acquirers of those assets when someone passes away, that they can have this asset that had all this gain before, but now they get it and it's got a new basis. That seems like a pretty massive win for those people that acquire the assets.
Absolutely. And we use it all the time in our estate planning practice. I spoke with a gentleman a week or two ago who, to use my example, has some family land, wants to give it to his daughters for them to hold and have, not with an intention that they would sell. And if they did receive it by gift during his lifetime, if he just gave it to them, then they would receive a transferred basis, which may be very low because it's not a current fair market value. If instead he holds that land until he passes away, then his daughters, his heirs, would receive a new basis in that asset that they receive. And then they could, later on, if they chose to, sell it and have much less taxable gain if they did that later sale. And so we often discuss with clients and understand, is this a low basis asset or is it a high basis? Meaning, is the basis close to its fair market value? And is there more of a benefit of giving away assets now versus holding on to those assets at death? And the real trade-off that we see with that, and the reason for that, as you say, the giveaway of free basis, was traditionally the federal estate tax. And so people may pay the death tax at currently a 40% rate, but all of their assets would receive a new basis for income tax purposes. But given that estate tax exemptions are so high now, people can hold on to a lot more assets and receive a lot more basis in the assets when they're in the hands of their heirs.
Yeah. And so is there ever a way that you can sort of manufacture basis? Like if you've got a husband and wife and husband owns an asset, and let's say that wife is sick or is older or is potentially going to pass away before husband for some reason, is there a way in which we can get assets into her name so that we can essentially manufacture a basis step up if we know who's going to die first or if we've got a pretty good guess?
We can. It's certainly a technique that we will use expected mortality to move assets around. We have to be careful. There's some rules that say you can't do that close in time to when somebody would pass away, generally within 1 year of their passing. And so we have to think through that, and there's some advanced planning that needs to be done if we see that on the horizon. But it's a powerful tool, again, because there's a way in which we can put it in let's say the wife may be expected to pass away soon. We move assets into her name, she lives for a while, and then it goes back to the husband, then he would receive a new basis in that, and he could sell the asset, diversify into something else, and not trigger that income tax, or put it into the hands of wife, and that asset does not go back to husband. Then maybe we can do some better planning with that as well. So lots of options, but need to be discussed, and it's very individualized for the person, the family, the asset itself.
I think there's been a lot of talk about there's a new tax act that is being discussed in Congress now, and I don't recall hearing anything about basis with respect to the current act that's being discussed. But I do know in past years there have been discussions over changing some of the basis rules. Is that anything that gives you any pause, or is it anything that clients should be concerned on that these basis rules could change at some point in time?
Sure. Well, my crystal ball is not any clearer than anybody else's. And I don't think often Congress knows what Congress is going to do when it passes a bill. But at this point, we don't see a strong likelihood that Congress is going to dramatically change the basis rules for most individuals. We think that these basis rules have been in place for a long time. There was a short period in the 70s where Congress changed the basis rules, but personally, I don't see that it's likely that we would have a significant change in these rules for most clients that come in. There are some special rules with respect to what's called a grantor trust and some gifting rules that apply there. Generally, that's not something that is high on my radar. We're always watching, we're always reading these bills as they progress through Congress, because we always want to give advanced warning to clients and advisors so that people can make the moves that they may need to before Congress passes a law, passes a change. We can't always get ahead of Congress, but we try to.
Yeah. And so, Matt, as always, a major goal of this podcast is to give people clear, actionable advice that they can actually use in their lives. And so I had a contracts professor in law school that he always used to start examples with: a guy rides up to you on a horse. And so I'm going to use that example here with you, but to give the clear, actionable advice here, a guy rides up to you on the horse and he says that he owns an asset that's highly appreciated, and he's thinking about either selling this asset or giving it away. What is your advice to that individual? How do you kind of walk through the thought process for that individual in that situation?
Yeah, a lot of it is looking at that individual and what their expectations are. If this is an 85-year-old gentleman who maybe has health issues and he says, I don't have long to live, what should I do? Then we would lean more towards saying, well, let's think about holding on to that asset and obtaining the step up in basis, and your heirs can sell this. Or let's consider whether we need to sell this to generate other cash or other things. There may be other needs. Tax does not have to drive all the decision making. This is a young gentleman who there's not a mortality expectation for him anytime soon, then we don't want to play that basis step up at death. And there's other options that we would look at. So it's very dependent on what are his cash flow needs for that asset, what would be the tax effect of the sale of the asset quantified in real dollars, and what does he expect to do after he doesn't have that asset? Does he intend to invest it in something else? Is there a reason from a risk standpoint to diversify out of that asset? It's a huge host of factors to address. As far as what individuals can do right now with their assets, it's important to keep track of and know what the basis in your assets are, and talk with a financial advisor or financial planner, or certainly CPA and attorney, to help understand what would be the tax effects so that you can be proactive instead of reactive in looking at any sale or transfer of assets. And then really just understanding the basis rules and understanding the step up in basis rules.
Well, Matt, my advice to anyone in those situations is going to be to just come and talk to you, because you're obviously on top of all of these issues. Thanks again for joining us today and for providing all of those considerations on basis and why it's important. And I look forward to having you join me on future episodes of TFE Talks.
Thanks, Jordan. Appreciate it. Looking forward to it.
Thanks for listening to TFE Talks. For more information, please visit our website at www.tfelawfirm.com. You can also follow us on LinkedIn, Facebook, and Instagram by clicking the links below in the show notes. If you have any questions about topics discussed in the episode, or you have recommendations for future topics, please email us at info@tfelawfirm.com. See you next time.